Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today I'm joined by Tony Waters from QVG and Andrew Mitchell from Ophir, and we're talking about those emerging companies that are flying at the moment. Start with you, Andrew. It started its life as a listed company on a bad note, but Kogan has roared ever since. Buy, hold or sell?
A sell from us. Ruslan and David, they're smarter than all of us combined, and they're selling. I'm going to follow their money. Or I will say though that the NBN does provide a great opportunity for them, but I'm following their money and I'm selling. Insiders
have been diving for the sidelines in Kogan. Buy, hold or sell, Tony?
High conviction sell from us. Look, you know, this is ridiculously priced. 600 million plus valuation for effectively an NBN mobile reseller. You know, we don't think it's high quality business as some would suggest, you know, and I think Ruslan Kogan would agree with us given that he's selling stock. You know, well overpriced in our view.
Okay, the whole world wants to buy Australian naturally grown foods, Freedom Foods. Buy, hold or sell?
Sell again. Look, you know, this business has poured about $500 million in capital over the last 4 or 5 years into this business. Even if you look at prospective earnings coming from that, you know, you're going to get a low teen return on capital at best. We love the theme in terms of where this business is going, in terms of good nutritional food, but we don't like the maths. You know, you're looking at things like Synlait and more from a primary production end in Costa Group. Again, high growth stocks, but much better traction in terms of the returns driven from its capital base.
Okay, Freedom Foods, been a terrific performer. Another one?
Buy, yeah, a buy for us. We own it. We've actually taken a bit of stock off the table recently. But you look at where the global peers trade, they trade on big multiples. This is a quality asset that they've got. The market is underappreciating in our view, the kids China JV, a milk JV, and also the cut through that they're getting with cereal. It's got accelerating growth. It needs to grow into its multiple, but we'll say it's a buy.
Let's get towards a business that we're all a bit sympathetic towards, funds management. Pinnacle, buy, hold or sell?
A buy. Firetrail, they're very smart guys. We think that fund's going to be full. These are the ex-Macquarie guys who have gone over there. We think that fund will be full at the end of the year. We also think that there's opportunity for more LICs and more managers, but you're paying a lot for this stock. You need the market to keep going. We think the market's got a few more years left in it, so we'll say a buy.
You can't go wrong being in funds management, Tony. We know that. That's why we're all in it. Pinnacle, buy, hold or sell?
It's a hold for us. I mean, you know, this is now trading at a multiple that's higher than where Magellan was or the old BT was when they bought Hambro in its sweet spot. So it's now fully priced in. You typically get 3 to 5 years of very good inflows in these models before capacity issues start to bite. And then the multiples halve in these business, and that's been the history with other listed fund managers. And there's no real sugar hit for the next earnings result, given that there's not a big pot of outperformance and performance fees coming in the next result.
Okay, let's hear an emerging company that's flying at the moment that you can tip us into.
I'm going to start off with a preface that early stage emerging companies and small caps are extreme valuations at the moment. So the one that's probably gets closest to the, you know, for us in terms of the best idea is Nearmap. And the reason being is, you know, hidden those earnings is losses that's coming from US. This is a business that provides aerial mapping services and, you know, some very good software innovation in terms of putting that together for a user platform which helps for solar companies, insurance companies, infrastructure companies and the like in terms of managing their assets. Very good growth in the US, but still not profit making, but a very good profit base in Australia of which to fund that from. You know, if you took the accounting and capitalised some of those US loss earnings and looked at the overall earnings performance, you know, we think that business is still pretty richly valued, but out of an early stage, a lot of companies which we think in some cases are ridiculously overvalued. That's probably one of the better ones that we would see in the market.
Okay. Andrew, can you beat that? Have you got something better?
Well, I think I'll agree with what Tony's saying, that you're seeing the valuations really stretched in all the growth companies. I've got one that's a little bit bigger, but McMillan Shakespeare, you've got 10% organic growth in the business. This is a novated leasing and salary packaging business. You've got 10% organic growth in the business, and the company's actually really punching investors in the face saying we're taking a lot of costs out of this business right now and we think the margins can go a lot higher. We think their margins will go from 45 to 55%. after speaking to lots of people in the industry. That will happen over the next 5 years. That takes your growth rate from 10 to sort of 12, 13. It's got net cash balance sheet. That takes you to 14, 15, 16 when they start making small bolt-on acquisitions. And you're paying 13.5 times PE 1 year forward for that business. So we see that as an emerging growth, like the growth I don't think the market really appreciates how much growth it has. And we think that there's a re-rate when the market works that out.
Well, they might be emerging in name, but a few of these stocks are going to be submerging soon because they're so expensive.